Federal Reserve Chairman Jay Powell. He said the economy is doing well yesterday. He addressed the New York Economic Club yesterday. Powell said that the Fed is close to fulfilling its goals of promoting maximum employment and price stability.
The unemployment rate is 3.7%, a 49-year low, and many other measures of labor market strength are at or near historic bests. Inflation is near our 2% target, and the economy is growing at an annual rate of about 3%, well above most estimates of its longer-run trend. My FOMC colleagues and I, as well as many private sector economists, are forecasting continued solid growth, low unemployment, and inflation remaining near 2%.
Those comments, particularly about being close to neutral on rates, 2%, getting the attention of investors. The Dow Industrial shot up, as you can see, closing up better than 600 points on the session. That was 2.5%. Joining me right now in a Fox Business exclusive, UBS Chairman Axel Weber. Great to see you, Mr. Chairman. Thank you for joining us. Your reaction to Jay Powell yesterday?
I think as a former central banker, I would say there was nothing extraordinary, he said. He was just acknowledging that by now, after several rate hikes over 2 or 3 years, the Fed is close to neutral. And I think the real issue for markets is they have been quite gibbery this year because 3 major expectations of what really supported equity markets in the past are starting to be questions. The first is, will earning growth continue to be as strong as it has? And there's some doubt about that. The second one is really monetary policy that was a major supporter of equity markets is starting to be at neutral, so it's less supportive, may actually become restrictive. And the final point is the economic data we're seeing are more mixed. So there is a mix of headwinds that the markets are experiencing that we haven't seen in that combination for the last couple of years.
But, you know, there are other things that the Fed is dealing with. I mean, you were the chairman of the Bundesbank, the president of the Bundesbank, and you didn't have the kind of issue of winding down a $3 trillion balance sheet, right? That's one of the issues that the Federal Reserve faces right now, not just raising rates, but winding down the balance sheet. Are they going to be able to do that without tightening too much, too fast?
But that's exactly what Jay was pointing at. There are 2 issues that they face. First one is they need to contain inflation because with the economy doing well, there is a risk that inflation will go up. It's been pretty contained. The Fed was able in this cycle to raise rates roughly at half the speed of what they did in the past, and they've traveled about half the distance. And the real question is, I don't think that normalization of monetary policy will be completed in the current cycle. It will take another economic cycle to really go to neutral because after a very long period of very low interest rates, raising interest rates has happened very cautious, but the balance sheets are still very, very expanded. So they'll continue to reduce the balance sheet. But my expectation is they won't even go back to where the Fed's balance sheet was before the crisis. Central banks have now become a much larger central counterparty in markets. And for that, I think structurally, central bank balance sheets will be larger. And I think there's good reasons to be cautious about normalizing monetary policy because we're coming out of a 10-year low interest rate environment. And therefore, you have to be cautious and you should not overshoot. You need to look at the economy where central bank support has been taken for granted for a decade. And weaning that off has to happen with some eyes on a really cautious normalization. They can't stay where they are for a long time because financial market stability could be threatened. And that balance was pointed out by Jay Powell yesterday.
But, of course, as rates move higher and as we see commodities prices facing the impact of perhaps tariffs, you're seeing this worry about margins. So market has been very volatile. Are you seeing margin pressure at UBS?
No, I think what we're expecting going forward is there will continue to be challenges in the markets and margin pressure will arise here and there. But the real challenge that I think the markets will have is liquidity. As the ECB gets off their purchase program, for the first time in the last 10 years, central bank balance sheets globally, the sum of what central banks are doing, will no longer support the economy. It will no longer expand balance sheet. Central bank balance sheets globally will start to shrink. And that is a new phenomenon because so far the ECB's expansion and the Bank of Japan's expansion has more than made up the shrinking of the balance sheet by the Fed. That will change at the end of the year. So there's clearly going to be some headwinds for the next year economy. There's clearly going to be some headwinds from, the effects of the tax reductions and fiscal reforms in the U.S. are starting to wane. market growth is going to be more normalized, but there's no reason to worry. I don't see an imminent recession on the horizon. Maybe a soft spot in the economy for the next first half of the year, because one thing that is taking toll now is these trade disputes, which didn't really impact the economy, but now with China, US heading ahead in a sort of more conflictual way, many global firms are rewiring their global production chain. So multinationals are really changing the way where they produce and how they produce, and that is taking a toll for a short term on the economy. So I expect the first quarter, the second quarter next year to be quite weak, and that is a soft spot. It's not a recession. Most data that we're seeing are not in the typical pattern of what usually you see before a recession.
So you are expecting a weak first and second quarter in 19 then?
Absolutely.